All right, let's dive right in. We're looking at something weird happening in the Bitcoin market. For years, it had this predictable rhythm, almost like clockwork. Well, that clock, it's just shattered, and we're going to figure out why. So here's the central mystery we're trying to solve. 2025. That was supposed to be the year for Bitcoin, the big one. We're talking explosive, new all-time highs, that crazy momentum we all know. But it just fizzled out. A huge disappointment. The big question is, what on earth went wrong?
Okay, so our first stop in this investigation is what we're calling the broken cycle. Think about it. This 4-year pattern was something you could almost set your watch to. It was reliable. And for the very first time, it has completely, utterly failed to deliver.
I mean, just look at the difference between what we expected and what we actually got. It's night and day. We were all geared up for this explosive ride to the top. And what happened? Prices just stalled out, went totally flat. We were looking for a historic peak, but instead, people just stopped using the network. Engagement totally collapsed. And all that powerful momentum we were counting on, it didn't just stop, it threw itself into reverse.
And it's not just a feeling. If you look at the data, for instance, from analyst Willy Woo, his models are basically screaming at us. They're about 95% certain that we're already in a bear market, and that it started way back in October. Think about that. The party was basically over before the music even really started playing.
But here's the thing. This isn't just a Bitcoin problem. It's not happening in a bubble. You've got Bitcoin's predictable internal rhythm, its own little engine, but it's running straight into a hurricane. And that hurricane is the global economy. And right now, it is getting really, really hostile. And when that happens, well, it changes the entire game.
All right, so what's our first major clue in this mystery? This is a big one. For the first time in its entire life, Bitcoin is staring down a global economic situation it has never, ever experienced. And boy, is it sending us a signal.
Just look at gold for a second. Right now, gold is beating stocks. That might not sound like a huge deal, but it's incredibly rare. Historically, it only happens when the entire financial system is under massive stress. I'm talking about the biggest crises in modern history. The Panic of 1907, the Great Depression, the dot-com bust, the 2008 meltdown. When gold acts like this, it's a massive red flag, a warning siren we haven't heard in more than a decade.
And this is the absolute kicker. Remember when Bitcoin was created? Right after the 2008 crash. It's a crisis, baby. It has never lived through one of these huge global economic shocks. So what does that mean? It means every model, every prediction, every expectation we have about how it's supposed to act, we can pretty much just throw it out the window. We are completely off the map here.
What's really interesting is, if you look back at 2017 and 2021, Bitcoin has always been the first to stumble. It peaks and starts to break down before the rest of the markets even know what's hit them. So the fact that it's so weak right now, well, that could be telling us that the real economic pain hasn't even started yet. It's the canary in the coal mine, and that canary is not looking too good.
Okay, so we've looked at the big picture, the global storm. Now, let's zoom in. Let's look inside the Bitcoin world itself. Because there's another clue here, a key ingredient that's just missing.
So let me ask you this. Think about every single massive Bitcoin rally in the past. What did they all have in common? What was that rocket fuel that sent the price into the stratosphere every single time?
The answer? Everyday people, retail investors. And that, my friends, is the problem. Look at who's been buying this time around. It's almost all big money players, institutions, corporations. A good chunk is just old school holders moving their money around. But new people, new retail investors jumping in, it's a measly 1%. One! That's basically nothing.
And the fallout from that is massive. Without that retail FOMO, that fear of missing out that gets everyone so excited, you just don't get those explosive price moves. It means fewer people are actually using the network, buying and selling. The price just can't expand like it used to. Basically, the engine that powered every other bull run is completely missing in action.
Okay, so we've got the global economy problem and the missing retail problem, but there's a third piece to this puzzle. It's not just about what's missing, it's about what's new. There are new risks on the board now, and they have completely rewritten the rules of the game for Bitcoin.
And this might be the biggest, most overlooked threat of them all: quantum computing.
We're talking about the risk that someday a super powerful quantum computer could just crack Bitcoin's security wide open. And look, even if that day is years away, the fact that it's even a possibility, that's enough to give the big money institutional players some serious heartburn.
And to get why this matters right now, you have to get inside the head of these big institutions. See, they don't need to be 100% certain that something is going to fail. All they need is credible uncertainty, just a plausible risk, even if it's way off in the future, that they can't just ignore.
And that's it. That is enough to keep a massive amount of their capital sitting on the sidelines. It puts a hard cap on how big this can get, at least for now.
And we're not talking about a quick fix. Experts think this cloud of uncertainty could hang around for the next 8 to 10 years. They're calling it Bitcoin's hardening phase. It's like a trial by fire, a long, tough period where Bitcoin has to prove, beyond a shadow of a doubt, that it can survive this new kind of threat.
So, let's put it all together. We've got the broken cycle, a global crisis flashing warning signs, no retail investors showing up to the party, and this new, scary quantum risk. With all that on the table, what's the final verdict? What does this all mean for Bitcoin's future?
Well, if we're looking ahead to 2026, the forecast is not exactly explosive. It looks like a year of either going down or just moving sideways, what we call consolidation. The data points to a potential peak somewhere between $84,000 and $95,000. Now, for that to change, something real has to happen. We'd need to see a huge wave of actual new money coming in, not just hype and stories, but real capital.
So where does this leave Bitcoin? What's its job in this new world? Well, long term, its promise as a store of value, like digital gold, is still totally there. But right now in the short term, it's just too volatile. So the main mission, the number one priority, has to be proving it's a reliable, long-term safe haven. Everything else, all the other cool ideas, they've got to take a back seat for now. So here's the bottom line, the big takeaway from all of this. The game has fundamentally changed. The next 10 years for Bitcoin aren't going to be about those crazy, hype-fueled moonshots. It's going to be about something way more fundamental. Survival. It's about building real, lasting trust and making the network tough enough to withstand challenges it has never, ever seen before.
And that leaves us with one last really big question. After all the ups and downs, the booms and the busts, is this, right now, this perfect storm of a hostile global economy and brand new existential threats, is this Bitcoin's biggest test yet?
Welcome back to the Deep Dive. Today is Wednesday, February 4th, 2026. And I want to start by just looking at a number, just a simple number on a screen. $86,400. That is where Bitcoin is trading as we speak.
It's a respectable number, historically speaking. I mean, if you zoom out, it's still an incredible performance over the last decade.
Respectable, I guess. Maybe. But let's be real for a second. If I had told you back in 2023, or even, early 2024, that in February 2026, a full 6 months after the peak of the 4-year cycle was supposed to happen, that we would be sitting at 86K.
You would have been laughed out of the room.
I would have been laughed out of the room. The models, all of them, they said $200,000. Some said much higher. The gurus were talking about a super cycle. The whole sentiment was that 2025 was going to be the year of the God candle.
And instead, 2025 was the year of the God yawn.
Worse than a yawn. A yawn implies it was boring. This feels, it feels like a betrayal of the pattern.
Yeah.
We're all looking at the same charts, we're looking at the sentiment, and the mood out there is just, it's heavy.
It's confused. The confidence is gone.
Exactly. People aren't posting laser eye memes anymore. They're, posting screenshots of their losses, or more often than not, just staying silent.
And silence is usually the loudest signal in this market. When the hype dies, you see who's really here for the technology.
So we have to address the core question, the elephant in the room. The narrative for the last decade has been the 4-year cycle. It's the clock that runs the crypto universe. It's almost biblical. But looking at the data we have today, looking at the performance of 2025, is Bitcoin broken? Or is the world around it broken?
That is the fundamental distinction we need to make today. And that's why the research stack for this deep dive is so fascinating, because it finally stops looking at Bitcoin in a vacuum. We've got analysis on what they're calling the broken cycle, some really deep dives into on-chain data from analysts like Willy Woo, and this really ominous data point regarding what the sources call the 2026 crisis signal.
Crisis signal is not exactly the morning coffee vibe I was hoping for, but okay, let's get into it. The core thesis here, then, is that the cycle, the one thing everyone bet the farm on, has officially failed.
It has failed. I think we can stop pretending it hasn't. Historically, if you look back at the halving events, the fourth year, which would have been 2025, is the blowout top. It's the mania phase.
That's supposed to be the law of crypto physics.
It was. But 2025 was the anomaly. It was a dud. So our mission today is to figure out why. Why did the engine stall? Why didn't we get that explosive upside? And, more importantly, if the old map is useless, what map are we using now?
Okay, let's pop the hood then. Let's get into the anatomy of this failure. Before we get into all the gloom and doom, walk me through what should have happened. If the simulation was running correctly, where should we have been 6 months ago?
Right. So if we were following the textbook written by the 2013, 2017, and 2021 cycles, 2025, should have been a mania phase. A full-blown tell your grandma about it bull market.
The Uber driver giving you stock tips phase.
Exactly. The mechanics are supposed to be simple supply and demand. The halving happens in 2024, right? The supply of new Bitcoin being issued to miners gets cut in half. That is a daily, predictable, programmatic supply shock.
Right, simple economics, fewer new coins for sale, assuming demand is constant, price has to go up, go up technology.
That's the theory. The idea is that this programmatic supply shock forces price appreciation. That price movement then starts catching headlines on major news networks. That brings in the retail FOMO, which creates a demand shock. The two collide: supply shock meets demand shock, and you get a parabolic exponential run-up.
But the reality was, well, it was different.
The reality was that the supply shock happened. The code worked perfectly, but the demand shock, it just never showed up to the party. So instead of a rally, we got a stall, and then momentum actually reversed.
And looking at the data we have, particularly from Willy Woo's models, we can actually pinpoint the scene of the crime.
We can. This is what's so interesting. It wasn't a sudden crash. It was a slow decline. Everyone was waiting for October. You remember the memes? Everyone was waiting for that classic Q4 rally to take us to new all-time highs.
Of course. It was the last hope for the cycle playing out.
But the internal organs of the market were already shutting down. Woo's models track something called the bearish phase probability. It's not looking at price. It's an aggregation of on-chain health. So minor capitulation, investor flows, profit-taking, network growth. It's like a blood test for the network.
And what did the blood test say?
It said the patient was getting sick. In October 2025, while the price was just chopping sideways, lulling everyone into a false sense of security, this model quietly flipped. It signaled the definitive start of a bearish phase. And as of today, February 2026, that model is now 95% confirmed.
95%. So this isn't a bull market consolidation anymore.
We are in a bear market. The data is screaming it. The patient is in the ICU.
Okay, but I have to push back on this a little. You said the halving happened. The math didn't change. The code is still the same. Bitcoin is still producing block after block like clockwork. So if the supply shock is real and verifiable, why didn't the price follow? I mean, is the halving narrative just a myth we've been telling ourselves all this time?
It's not a myth, but it's not a magic wand either. And this is the crucial pivot point in our entire understanding of this asset class. The sources argue, and I think very effectively, that this isn't a failure of Bitcoin's code. It is a failure of Bitcoin's isolation.
A failure of its isolation. What do you mean by that?
For the first, say, 15 years of its life, Bitcoin ran on its own internal clock. It was small enough, it was niche enough, that the global economy didn't matter as much. The halving cycle was the dominant force.
It was a speedboat in the ocean. It could turn on a dime, create its own waves.
A perfect analogy. But now Bitcoin is an oil tanker, a massive, globally recognized asset. And it is sailing directly into a Category 5 hurricane. The Bitcoin halving cycle collided head-on with a rapidly deteriorating global business cycle.
So the storm was just too strong.
The usual supply shock, that reduction in new coins hitting the market, it simply wasn't strong enough to overcome the hostile economic forces bearing down on the entire world. The headwinds were just stronger than the engine.
It makes sense. Bitcoin doesn't exist in a vacuum anymore. It exists inside these broader liquidity cycles. And I guess the old saying is true. When the tide goes out, you see who's swimming naked.
And right now, the tide of global liquidity is going out. When that ocean drains, doesn't matter how buoyant your boat is, you're going to hit the bottom eventually.
Let's talk about that ocean then. Let's get into the liquidity trap, because this is the part that I think confuses a lot of listeners, myself included sometimes. I hear constantly that liquidity is rising, the government is printing money, we see the M2 money supply charts, and they're still generally going up and to the right.
The classic money printer go burr meme.
Right. And the basic equation in our heads for years has been M2 goes up, assets go up, Bitcoin is supposed to be the ultimate hedge against M2 expansion, against that debasement. So if M2 is rising, why isn't Bitcoin catching a bid? Why is the bucket staying dry when it's supposedly raining money?
This is the liquidity myth that the sources really dismantle. And we need to get just a little bit technical for a second to understand it, but it's crucial.
Yeah.
Yes, M2, which is basically cash, checking deposits, money market securities, is rising. There is more money in the system on paper.
Okay.
But we have to look at the velocity of money.
Which is how fast that money is actually moving around in the economy, how often it changes hands.
Correct. It's the turnover.
Yeah.
Think about it. You could print $1 trillion, but if the banks are terrified to lend it and businesses are terrified to invest it and consumers are terrified to spend it, where does that money actually go?
It just sits there. It sits in the vault.
It sits in the Federal Reserve's reverse repo market. It sits in treasury bills. It gets trapped in the financial plumbing. The source uses a great analogy. The water level in the ocean is rising, but Bitcoin is a bucket with a lid on it. The liquidity isn't flowing into risk assets like tech stocks or crypto. It's flowing into safety.
And that leads us directly to the most alarming signal on the research stack we have today, the gold divergence. Because if money is flowing to safety, it sure seems like it's flowing to the shiny yellow rock and not the digital orange one.
This is the single chart that should make everyone sit up straight. We are seeing a massive historic divergence. Gold is surging. It's breaking all-time highs, not just in dollar terms, but against almost every fiat currency. But Bitcoin is stalling. It's actually underperforming.
And they're usually cousins, right? They're supposed to be on the same team, the hard money trade against inflation.
That's the modern assumption. That's the narrative we've built. But history tells a very different and much more stark story. The deep dive sources highlight something critical. Gold only significantly outperforms equities and other high beta assets during periods of profound systemic economic stress.
So we aren't just talking about a regular recession where GDP dips by 1% for a couple of quarters.
No, we are talking about system breaks, moments where the fundamental trust in the financial system itself is cracking.
Give me the history. When has gold ripped like this while everything else struggled or collapsed?
The list is short and it is terrifying. 1907, the Panic of 1907, the Great Depression starting in 1929, 1968, 2001 after the dot-com bust and 9/11, and 2008, the global financial crisis. These aren't blips. These are seismic shifts in the economic landscape.
Okay, you said 1968. Stop there for a second. I feel like we always hear about 1929 and 2008, but 1968 gets glossed over. Why is that one important? Why is it a parallel for today?
1968 is arguably the best parallel for what we're seeing now. So back then, the world was on the Bretton Woods system. The US dollar was pegged to gold at a fixed price of $35 an ounce. To keep that price fixed, a group of powerful nations formed something called the London Gold Pool.
Okay.
Their job was to sell their own national gold reserves into the open market whenever the price started to rise. They were actively suppressing the price to keep the dollar looking strong and stable.
So, price fixing on a global scale, market manipulation.
Absolutely. But in 1968, the market broke the bank. The demand for physical gold, the flight to safety against inflation from the Vietnam War and reckless government spending was so high that the London Gold Pool collapsed. They literally ran out of gold to sell. The price exploded. It was the market screaming that the entire monetary order was fraudulent and about to crumble.
Which it did a few years later in 71 when Nixon closed the gold window. Wow. And you see a parallel to that today.
Look at the bond market. Look at what central banks are doing with yield curve control and quantitative easing.
Yeah.
They're desperately trying to suppress interest rates, trying to keep the system holding together with duct tape and promises. But gold breaking out like this, it's the market voting that they have lost control. It's the same signal as 1968. The plumbing is broken.
So gold is the alarm bell ringing, signaling a 5-alarm fire in the global economy. But here's the problem. Here's the uncomfortable part for us. Bitcoin wasn't around in 1907.
Nope.
It wasn't around in 1968. It wasn't even really around for the crash of 2008.
Well, technically, the white paper was released in October 2008, and the network went live in January 2009. So it was born from the crisis, but it didn't trade through the crisis. It didn't exist as an asset people could flee to during the Lehman Brothers collapse.
So we're flying blind.
Completely uncharted territory. We have zero historical precedent for how Bitcoin behaves in a true systemic crisis where capital is fleeing for its life. Everyone assumes Bitcoin is the safety. The digital gold narrative, which I've used myself, says that when the banks fail, you buy Bitcoin.
But right now, the market is voting with its wallet, and it's choosing the 5,000-year-old metal over the 17-year-old software.
Because gold has a 5,000-year track record of survival. It survived the fall of Rome, the World Wars, the Great Depression. It is the ultimate cockroach asset. Bitcoin has a 17-year track record. In a true crisis, liquidity doesn't seek potential, it seeks certainty. And for the big macro funds, Bitcoin is still a risk-on asset. It's still in the tech bucket, not the safety bucket.
So if gold is screaming system failure, what is Bitcoin doing? Is it just a bystander watching the fire?
The sources suggest something a little more active than that. They suggest Bitcoin is acting as the canary in the coal mine.
The early warning system.
Precisely. If you look at the patterns, even in recent history, like the bull market tops in 2017 and 2021, Bitcoin tends to break down before traditional markets do. It's extremely sensitive to liquidity conditions. It's like it has a sixth sense for when the flow of capital is about to reverse.
It feels the draft before the window blows open.
That's a great way to put it. So the implication is that Bitcoin catching a cold means the rest of the market is about to get the plague.
That's sobering. It completely flips the script. We usually think of Bitcoin leading the charge up, but here it might be leading the charge down, or at least signaling that the danger isn't over yet, that the other shoe is still to drop.
It forces us to reevaluate our portfolio thesis. Are you holding a risk asset, or are you holding a safe haven? Because right now, it is trading like a tech stock that is starved for capital. And its weakness, its inability to rally despite the rising M2, suggests that broader financial stress is still unfolding. The fuel for a rally is gone. The canary has stopped singing.
Speaking of being starved, let's talk about being starved for attention. For people, because I walk around, I look at social media, I talk to friends, and I ask myself, where did everyone go?
The ghost town effect.
It's real.
It really is. In 2021, I couldn't go to a Thanksgiving dinner without my uncle asking me about Dogecoin. My Uber driver was giving me technical analysis on Cardano. We had the laser eyes everywhere. Matt Damon was telling us fortune favors the bold. Now, crickets. Where is the hype? Where is the energy?
The missing ingredient, and it's the most important one for a parabolic rally, is retail FOMO, fear of missing out.
The little guy, the average person.
The average Joe, the normie, whatever you want to call them. We have to understand that previous bull markets were not driven by institutions. They were driven by urgent, emotional, viral buying from regular people. When your neighbor buys a new car with crypto gains, you feel that pang of jealousy of being left behind, and you buy.
It creates that viral loop.
Yes, it creates a viral loop that on-chain analysts call a price multiplier effect. It's a fascinating phenomenon. How much of a multiplier are we talking about? Like, what does that actually mean?
In past cycles, for every $1 of real fiat money that entered the market, the total market cap might go up by $3, $4, or even $5. It was because the supply on exchange is very thin, and the buying was fueled by leverage and pure, unadulterated emotion. Yeah. But when you look at the on-chain data for 2025 and early 2026, that phenomenon simply never appeared.
So why not? Did people just run out of money? Or did they get smarter?
It's a bit of both. The cost of living crisis is real. People are trying to afford eggs and gasoline, not speculate on Shiba Inu, but also they got burned badly. 2022 hurt a lot of people.
FTX, Celsius, Luna, the list goes on.
That scar tissue is still there. The trust hasn't fully returned. The promise of easy money was revealed to be, for many, a promise of easy losses.
But wait a minute. We saw headlines all through 2024 and 2025 about the ETFs. BlackRock, Fidelity, all the big boys from Wall Street. They were buying billions of dollars worth of Bitcoin. If retail isn't buying, someone is buying, right? The price isn't zero.
Yes, someone is buying. But the composition of the buyer has fundamentally changed. The market has shifted from being retail-driven to being institutionally driven.
And I remember we all cheered for that. We said, the institutions are coming. The smart money is finally here. We thought that was the holy grail that would legitimize the space.
Be careful what you wish for. Because institutional money is, well, it's boring.
Boring? How can billions of dollars be boring?
It's calculated. It's unemotional. It's algorithmic. An institution buys based on strict asset allocation models. Their investment committee says, we want a 1% exposure to digital assets. So they buy 1%. They rebalance quarterly. They use sophisticated algorithms to buy slowly over weeks to avoid slippage and moving the price.
So they don't panic buy at the top because their cousin told them to at a barbecue.
Exactly. They don't provide the rocket fuel. So what you get is not those violent, explosive upside wicks that create the FOMO. You get a slow, methodical grind. We traded the explosive, manic energy of retail for the slow, steady corporate plotting of Wall Street.
And the sources suggest there's a darker side to this institutional adoption narrative that we've all been sold.
There is. We need to talk about the concept of recycled capital.
Okay, that sounds like a recycling bin logo on a dollar bill. What does it actually mean?
It means that a significant portion of the inflows we see reported in the ETFs isn't actually new money entering the Bitcoin ecosystem. It's just money changing pockets within the ecosystem.
Okay, give me an example. Paint the picture for me.
All right, let's imagine a wallet we'll call Satoshi Fan 99. He's a true OG. He bought a bunch of Bitcoin back in 2015 for a few $100s. He's sitting on massive, life-changing gains. But he's getting older, he wants to buy a house, or maybe he's just looking at the same scary macro data we are.
Okay, so he's thinking of de-risking.
Right. So he decides to sell some of his Bitcoin on a major exchange like Coinbase. Now, at the same time, a pension fund has just decided to allocate 0.5% of their portfolio to the new BlackRock Bitcoin ETF.
I'm with you.
So BlackRock's ETF custodian, which happens to be Coinbase, needs to go buy Bitcoin on the open market to back the ETF shares. Whose Bitcoin do they buy? They buy the coins that Satoshi Fan 99 just sold. The Bitcoin simply moved from one wallet on Coinbase to another wallet on Coinbase.
But the net amount of actual US dollars in the system didn't change at all.
Exactly. The OG took liquidity out of the system when he took the cash, and the institution put liquidity in. It's a net wash. For the price to go parabolic, you need both the OG to hold strong, to have diamond hands, and for the new institutional money to come in and bid up the scarce supply. But right now, the OGs are the ones providing the supply. They're selling into the institutional bid.
So why are the OGs selling? If they are the true believers, the diamond hands, why bail now? Is their conviction wavering?
I wouldn't call it bailing. I would call it rational risk management. Whale psychology is different from retail psychology. If you are sitting on 100x or 1000x gains and you see the yield curve inverting, you see gold spiking, you see geopolitical instability in the headlines, you take some chips off the table, it's the responsible thing to do.
So the whales are de-risking, the institutions are absorbing their selling, and retail is broke and scared. That really explains the stall perfectly.
It's a perfect storm for a sideways, grinding market with no explosive fuel. The on-chain and social engagement metrics confirm it. They're down dramatically.
Okay, I want to pivot now to the corporate side of things. Not the asset managers like BlackRock, but the operating companies that actually put Bitcoin on their balance sheet as a treasury reserve asset. The MicroStrategies, the Teslas, the Meta Planets of the world. In 2025, they were the heroes of the narrative. They were buying every dip.
The strategic reserve strategy is a huge narrative driver.
It was. But now the sources are flagging this very trend as a potential double-edged sword. How does something that was a strength suddenly become a major weakness?
The answer is leverage. Most of these companies didn't just buy Bitcoin with spare cash they had lying around. They were very aggressive. They issued debt to buy it. They sold convertible notes. They took out loans collateralized by their existing Bitcoin.
Ah, and loans come with rules. They have terms and conditions.
Exactly. They come with covenants. Or at the very least, they come with intense shareholder pressure. Now, imagine a scenario here in 2026 where the global recession we've been talking about hits hard. The core business of these companies, let's say software sales or car sales, slows down dramatically. Their cash flow tightens up.
And suddenly that pile of debt on their balance sheet looks a lot scarier.
Much scarier. If the price of Bitcoin drops below a certain threshold defined in their loan agreements, or if they just need raw liquidity to make payroll and keep the lights on, they might become forced sellers.
And we're not talking about them selling for a profit because they feel like it. We're talking about a margin call, a liquidation event.
Correct. And when a whale the size of a publicly traded company becomes a forced seller, they don't care about the chart. They don't care about the 200-week moving average. They get a call from their lender and they hit the market sell button on billions of dollars of Bitcoin.
It puts immense, immediate downside pressure on the price. It could trigger a cascade of liquidations across the market.
It's the ultimate centralization risk. We cheered when Michael Saylor bought all that Bitcoin, but now we realize that if his company sneezes, the entire market could get a cold.
However, the expert analysis does offer a sort of counterintuitive positive here. A silver lining, if you can stomach the short-term pain.
I'm ready. After all this, I need some hope. Give it to me.
Okay, so the argument is if these huge corporate whales are forced to sell, it will be incredibly painful in the short term. We could see a 30, maybe 40% wick down in a single day. But in the long run, it reduces concentration risk.
It spreads the coins back out into the market.
Exactly. It takes the coins out of the hands of a few powerful CEOs and distributes them back to the broader market, to smaller investors, to other companies, to whoever has the cash to buy the dip. Over time, that actually improves the decentralization of the network.
So it's a painful detox.
Yeah.
A necessary one, perhaps, for the network's long-term health. We can't have a truly decentralized currency if its ownership is concentrated in the hands of 5 public companies.
It's like a forest fire. It burns all the dead wood and underbrush so the forest can grow back healthier and stronger.
Precisely. But you really don't want to be standing in the middle of that forest when the match is lit.
Okay, so we've got a failing macro economy, missing retail investors, and corporate whales that might be forced to dump. That feels like enough to worry about for one day. But the sources we looked at didn't stop there. They had to throw in a sci-fi threat just to really keep us awake at night.
The underappreciated risk. This one is a sleeper threat that could become very real very fast.
Quantum computing. Now, I have to be honest with you. Every time I hear this topic come up, I roll my eyes a little bit. It feels like the Terminator is coming to steal my Bitcoin. Isn't this still science fiction? Years, decades away. Why are we talking about this in the context of 2026?
I get the skepticism, I really do. We've been hearing quantum is coming for a decade. But the sources identify this as the single most underappreciated threat to Bitcoin's long-term viability, specifically over the next 8 to 10 years. And the reason we are talking about it now is because of how sophisticated markets price future risk.
But first, explain the actual threat. What does a quantum computer actually do to Bitcoin? Does it just guess my password really fast?
It's a bit more complex than that.
Yeah.
We need to look at the encryption. Bitcoin security relies on something called ECDSA, the elliptic curve digital signature algorithm. Think of it like a very special kind of mathematical puzzle. It is incredibly easy and fast to verify the answer if you have it, but it's impossibly hard to solve the puzzle backwards to find the private key.
It's a one-way street. Easy to go forward, impossible to go back.
For a classical computer, yes. A normal supercomputer would take billions of years to crack a single Bitcoin wallet. It's effectively secure. But a quantum computer works on completely different principles. It can use an algorithm discovered in the 90s called Shor's algorithm.
Shor's algorithm.
And this algorithm allows a quantum machine to find the prime factors of very large integers exponentially faster than a normal computer. It basically turns that impossibly hard mathematical puzzle into a trivial math problem. If a sufficiently powerful quantum computer comes online, it could theoretically derive your private key just by looking at your public key on the blockchain.
So if I've ever sent a transaction from my wallet, my public key is out there on the public ledger. And a quantum computer could look at that and just calculate my password.
And steal all your funds.
Yeah.
Instantly. And it could do it for millions of wallets simultaneously.
Okay, that is genuinely terrifying. But again, the timeline, are we there yet? Are these machines being built in a secret lab somewhere?
We aren't there yet. The public research suggests we are in what the sources call the risk zone of the next 8 to 10 years. That's the window where it's plausible a state actor or a massive corporation could develop this capability.
8 to 10 years. In crypto time, that sounds like a lifetime away. Why should I worry about that now?
Because of a concept called credible uncertainty. I want you to put yourself in the shoes of a sovereign wealth fund manager. You are managing the pension money for an entire country. You have a fiduciary duty. You want to make an allocation that will be safe for the next 40, 50 years.
I want to buy and hold forever, the ultimate long-term store of value.
Right. But if your security advisors come to you and say there is a non-zero chance, even just a 1 or 2% chance, that the entire vault becomes unlockable and the asset goes to zero in 10 years, can you responsibly put billions of dollars of your citizens' retirement money into that asset?
No. Absolutely not. It completely kills the safe haven narrative. You can't call it digital gold if it might have a 10-year expiration date.
Exactly. The mere possibility is enough to keep that big conservative capital on the sidelines. And even though there are potential solutions, we can upgrade Bitcoin's code to use new post-quantum cryptography. The transition itself is a massive risk.
How so? If we can patch it, why is that a problem? Sounds like a software update.
Because Bitcoin is a decentralized system worth trillions of dollars. It's not like updating your iPhone. Who decides which patch to use? There are multiple competing standards. Who decides when to upgrade? It would require a network-wide hard fork, which is always contentious. And what happens to the billions, maybe trillions of dollars of Bitcoin in lost wallets, like Satoshi's original coins? That can't be actively moved to the new, safer encryption standard.
Oh, wow. I never thought of that. So if we upgrade the network, all the old unmigrated wallets might be vulnerable to a quantum attack.
They could be. Or they might be effectively burned. It creates a massive governance crisis. It could easily lead to a contentious hard fork war. You could have Bitcoin Quantum versus Bitcoin Classic.
And markets absolutely hate that kind of uncertainty.
Markets loathe it. So this shadow, the mere possibility of a quantum break or a messy political upgrade battle, is acting as a ceiling on institutional adoption. It's an invisible weight holding the price down.
It's the sword of Damocles hanging over the entire blockchain.
And the closer we get to that 8 to 10 year window, the heavier that sword is going to feel.
All right, you need to take a breath after that one. We've looked at the broken cycle, the missing retail, the corporate risks, and now the looming quantum threat. It's a lot. But we are here to provide a deep dive, not just a panic attack. So let's try to bring it all together and look at the forecast. Given all these headwinds, what do the numbers in the source material say for the rest of 2026?
The sources are quite specific here, and they are definitely not selling opium. The consensus forecast for the remainder of 2026 is likely a continued bearish or deep consolidation year.
So no rapid recovery, no V-shaped bounce back to all-time highs.
It's seen as highly unlikely. The estimated peak range mentioned in the analysis, if we do get some kind of relief rally, is capped between $84,000 and $95,000.
Which is basically where we are right now, maybe a little higher.
It implies we are chopping sideways. We are grinding. This is a period of accumulation for the patient and a period of frustration for everyone else.
What would prove this wrong? I always like to know the invalidation criteria. What signal would make you tear up the script and say, the bull is back?
It would have to be a clear, undeniable surge in real capital flows. We would need to see that M2 liquidity actually spilling over into risk assets. We would need to see the velocity of money pick up significantly. On-chain, we would need to see new wallet growth, a return of retail-sized transactions. We'd need to see the narrative shift away from fear.
So show me the money, not just the optimistic tweets from influencers.
Exactly. The narrative follows the price, not the other way around. Until the lid comes off that liquidity bucket, we're stuck in the bucket.
This makes me question the whole identity of Bitcoin then. If number go up is paused for a while, what is Bitcoin actually for right now? Is it still a store of value? Is it trying to be a medium of exchange? Can I finally buy a cup of coffee with it without feeling dumb?
The verdict from the deep dive is very clear on this. It remains an exceptional long-term store of value. Over any 5, 8, or 10-year horizon you want to measure, it has performed spectacularly in preserving purchasing power. But, and this is a big but, it is a poor short-term store of value because of the volatility.
Right.
You can't store next month's rent money in it.
And the dream of buying coffee, the medium of exchange use case.
The analysis says that is secondary, and it's a long way off. We need to look at the history of money, what they call the monetization process. Think about gold. How long did it take for gold to go from being a pretty shiny rock to being the foundational standard of global trade?
Centuries, millennia, really.
Exactly. It had to go through stages. First, it was a collectible. Then, as more people desired it, it became a store of value. Then, and only after everyone collectively agreed it had stable value, did it become a useful medium of exchange. And finally, a unit of account. Bitcoin is trying to speedrun 5,000 years of monetary history in just 20 years.
So we are trying to skip steps in the process.
We are trying to fast forward the movie. But the market is saying, slow down. We are currently and firmly in the store of value adoption phase. And you don't spend an asset that you believe will be worth much more in the future. You hoard it. That's what a store of value is for. You don't use it as currency yet.
So we are stuck in the awkward teenage phase of money.
The expert in one of our sources calls it the hardening phase.
The hardening phase. I like the sound of that, but it also sounds tough. It sounds like calluses forming after a lot of hard work.
It is tough. And
Yep.
that's the point. The expert frames the next decade, from 2026 onwards, not as a period of rapid adoption or going to the moon. It is about survival, trust, and hardening.
Explain that. What does a hardening phase actually look like in practice?
It means Bitcoin has to get punched in the face repeatedly and stay standing. It has to survive this coming macro storm, this crisis signal that gold is flashing. It has to survive a deep global recession where tech stocks drop 50 or 60%. It has to survive the quantum threat, either by proving it's not a threat or by upgrading successfully without splitting the network.
So it has to earn its stripes in the real world. It kind of had it easy for the first 15 years with a backdrop of cheap money and zero interest rates.
It was playing on easy mode.
Yeah.
The global environment was a massive tailwind. Now, the difficulty setting has been turned up to nightmare. If Bitcoin survives the next 10 years, if the network is still producing blocks in 2036, if it's still decentralized and censorship resistant after all of that, then it becomes truly anti-fragile. Then it have a credible claim to being the global standard.
That is a massive shift in mindset. We've been trained by the 4-year cycle to look at the chart every 15 minutes. Now you're saying we need to zoom out to a 10-year view just to stay sane?
If you want to stay sane, yes. The get-rich-quick phase of crypto is likely over. The preserve wealth for the long-term phase has begun. And that's a much slower, more deliberate process.
So let's wrap this up. We've covered a massive amount of ground today. The 4-year cycle failed because the macro environment finally crushed it. Retail is missing in action because the FOMO is gone and their wallets are empty. Gold is flashing a bright red alert for the global economy, reminding us of systemic crises like 1968. And on top of all that, we have these looming structural risks like corporate concentration and the existential threat of quantum computing.
It's a heavy list. I know this isn't the episode people wanted to hear, but based on the data, it's the episode they needed to hear.
It really sounds like the party phase is over. The days of effortless wealth, of just throwing a dart at a list of coin tickers and making money, that's done. And now the work phase has begun.
I agree completely. This is not a period for blind optimism or Lambo memes. It's a test of resilience. It's a test of your original conviction. It's very easy to be a Bitcoiner when the line is going up and to the right. It's very, very hard to be a Bitcoiner when the line is flat and the rest of the world looks like it's burning down.
Which brings me to the final thought I want to leave our listeners with today. And I want you to really sit with this and process it honestly. If Bitcoin is truly facing a decade of hardening, if we are staring down the barrel of a major economic crisis and these existential technological risks, I want you to ask yourself a simple question. Are you holding it because you actually understand the technology? Do you understand censorship resistance? Do you understand the importance of a fixed monetary policy? Or were you just waiting for the retail hype to come back so you could sell your bags to the next guy for a profit? Because if the hype isn't coming back, if the greater fool isn't showing up to the party this time,
then the only thing you have left is the fundamental thesis.
do you trust it enough to survive the storm?
That is the trillion-dollar question.
Thanks for diving deep with us. We'll see you on the other side of the crisis.
Stay safe out there.
Welcome to the debate. It is February 4th, 2026. If you're listening to this, you are. You're likely staring at a chart that, quite frankly, is refusing to behave according to the history books. We have just closed the book on 2025, a year that according to, well, essentially every major model from Plan B to the standard 4-year cycle theory was supposed to be the fireworks year. It was supposed to be the blow off top, the parade, the moment the asset went mainstream with a massive vertical green candle. Instead, we got a stalemate.
A stalemate is, well, that's a very generous way to describe it. If we're being honest with the data, we didn't just get a pause, we got a breakdown. We are looking at what everyone is now calling the broken cycle.
That is the phrase of the moment, isn't it? The broken cycle. And that is the central question we're tackling today. It's simple, but incredibly uncomfortable for anyone holding the asset. Why? Did the cycle break because of temporary external pressures, macro headwinds that will pass? Or are we witnessing a fundamental failure of the Bitcoin adoption model and the safe haven narrative?
Exactly. And just to set the stage for where I'm coming from, I'm arguing that the data signals a structural failure. When you look at the divergence from gold and the complete evaporation of retail interest, the digital gold thesis is actively collapsing under the weight of liquidity issues and, frankly, some existential technical threats that nobody wants to talk about.
And I'm taking the other side. I argue that what feels like a failure is actually a necessary maturation. Bitcoin is behaving exactly as a rational, hardened asset should in a hostile economy. It's not failing, it's acting as an early warning system. But I want to start with the elephant in the room, 2025. It hurt. We all expected the euphoria phase, but I want to reframe that disappointment immediately. If you look at the source material we're analyzing today, specifically the concept of survival versus trust, what we're seeing is the collision of two massive forces, the internal cycle and the external business cycle. For the first time in history, Bitcoin's supply shock, the halving, walks straight into a global recessionary wall.
But hold on.
You can't just blame the macro environment. That's the easy out. It feels like an excuse. We have a control group in this experiment, gold. Look at the charts. Gold is breaking out to all-time highs. Historically, gold only decouples from equities in surges like this during moments of deep systemic stress. Think 1907, the 1930s, 1968, 2008. We are in that kind of company right now.
I don't dispute the severity of the macro environment. It's hostile, absolutely.
But that is the point. In every one of those scenarios I just mentioned, capital fled to safety. That is the pitch, right? That's the bumper sticker. Bitcoin is the hardest money ever discovered. If that thesis held water, capital should be flowing into Bitcoin alongside gold. But it isn't. Global liquidity, M2 money supply, is actually expanding right now, yet it is specifically bypassing the Bitcoin network. That isn't maturation, that's rejection. The market is voting with its wallet and is choosing the shiny rock over the digital blocks.
I think you're conflating price action with signal integrity. Yes, gold is rallying and Bitcoin is struggling, but look at the timeline. Bitcoin broke down before traditional markets rolled over. It did this in late 2017, it did it in late 2021, and it did it again in late 2025. It is the canary in the coal mine because it's the only truly free market, 24/7 liquidity, no circuit breakers, no bailouts. It senses liquidity crunches before the S&P 500 or even gold futures do. The fact that flows are fading is a signal that the real fuel for our broad market rally is absent. It's validating its sensitivity to global liquidity conditions.
That's a very convenient narrative, though. We aren't going down because we're weak. We're going down because we're smarter than everyone else. But let's look at the mechanics of who is actually in the market. You talk about sensitivity to liquidity, but in previous cycles, that liquidity was amplified by a specific demographic, retail. The retail FOMO, that urgent emotional buying from the average person trying to front-run institutions. That demographic is gone. Vanished. The data for 2025 shows buying was dominated almost exclusively by institutions and corporate treasuries.
I agree. The retail moon boys didn't show up. And I say, good riddance.
You can't be serious. That retail layer provided the base layer of distribution. Without them, what do we have? We have a closed loop. The capital entering the space in 2025, mostly corporate treasuries like MicroStrategy and the copycats, is just recycled money. It's longtime holders, the OGs, selling their coins to corporations. It's not fresh adoption, it's just a shuffling of chairs on the deck.
See, this is where we fundamentally disagree on what adoption looks like. You are mourning the loss of hype. I am celebrating the arrival of infrastructure. The shift from retail-driven mania to institutional accumulation is the definition of asset maturation. When retail drives the price, you get volatility, you get leverage flushes, you get 80% drawdowns. When corporate treasuries drive the price, you get a balance sheet asset. The fact that the 2025 cycle was defined by treasuries rather than TikTok influencers shows we're moving from a gambling chip to a reserve asset.
But is it a good balance sheet asset? That is the gamble these CEOs are taking. You're treating corporate treasuries like they're these diamond-handed ideological saviors. They aren't. They are public companies. They have shareholders. They have quarterly earnings reports.
They have conviction.
Conviction lasts exactly as long as solvency. In a bearish 2026, which we both agree is likely, these massive treasury positions become a liability. If Bitcoin continues to bleed or just chop sideways in this 80K range, these companies are going to face massive pressure. They might be forced to sell to cover operating losses or to appease a board of directors. That isn't infrastructure, that is concentration risk. We spent 10 years worrying about miners capitulating. Now we have to worry about a CEO needing to buff up their Q3 earnings by dumping 5,000 BTC onto a market with thin order books.
That is a fair risk to highlight, I'll grant you that. But play that scenario out. If they sell, what happens? The price drops, sure, but the coins get distributed back into the order book. That is the system correcting itself. That is the hardening phase I mentioned. The protocol doesn't care if a corporation sells. The blocks keep producing every 10 minutes. And frankly, the smart money, the whales, are acting rationally right now by sitting on their hands. We saw this in 2014 and 2016. When uncertainty is high, smart money waits. It doesn't mean the asset is broken. It means the players are risk averse.
Risk averse is one way to put it. Terrified might be another. I want to circle back to the gold comparison because you waved it away a bit too quickly. We can't ignore the historical weight of what is happening. We are in a period that looks like the end of the Bretton Woods system. The entire monetary order is being questioned. This should be Bitcoin's Super Bowl. This is literally the marketing pitch, a hedge against monetary debasement.
And it is serving that function over a long time horizon.
But in the immediate crisis, no. M2 is going up, inflation is sticky, and Bitcoin is flatlining. If it can't perform its primary function during the exact specific crisis it was designed for, then the thesis is failing. If I buy fire insurance and my house catches fire and the insurance company says, well, actually we're in a hardening phase, come back in 4 years, that is a failed product.
That is a category error. You're comparing an asset with 5,000 years of history, gold, to one that is barely old enough to drive a car. Bitcoin has never existed in a high interest rate, hostile macro environment before. It is in price discovery mode. Gold has had centuries to establish its correlation with systemic stress. Bitcoin is currently fighting two battles simultaneously, the battle for store of value status and the battle against the business cycle. It is unrealistic to expect it to behave perfectly like gold in its teenage years. The fact that it is even in the conversation with gold during the systemic stress event is a victory.
Give it time is a dangerous investment thesis when the opportunity cost is this high. Capital flows are ruthless. They don't care about the teenage years of an asset. If liquidity is present and it chooses gold over Bitcoin, that is a vote of no confidence. And I think there is a specific reason for that vote of no confidence. It's not just the macro. It's something inside the tech stack.
You're referring to the technical risks?
I'm referring to the single most underappreciated threat to this entire ecosystem: quantum computing.
I figured we would get here. This is the sword of Damocles argument.
We have to go there. The source material is explicit about this. We aren't talking about science fiction anymore. We are talking about engineering roadmaps from IBM, Google, and nation-states. Even if a full cryptographic break, where a quantum computer can derive your private key from your public key, is years away, markets price risk in advance.
Efficient market hypothesis.
Exactly. We are looking at a window of 8 to 10 years of credible uncertainty. Institutions hate uncertainty. They can handle risk. Volatility is fine. They can hedge that. But they cannot handle the possibility that the underlying security model might be zeroed out.
I agree that it's a threat, but I think the market reaction is efficient, not catastrophic. The network is aware of this.
Is it? Put yourself in the shoes of a chief investment officer at a pension fund. You are being told to allocate to digital gold for a 20-year horizon. But you also know that within that horizon, there is a non-zero chance that the elliptic curve digital signature algorithm, the lock on the vault, becomes obsolete. Why would you buy now? Why not wait until the quantum-resistant upgrade is actually live and tested? That hesitation is exactly why the safe haven narrative isn't sticking. The liquidity isn't flowing because the long-term security guarantee is under question.
I see why you think that, but let me give you a different perspective. The quantum threat is a known variable. It's not a black swan anymore. It's a gray rhino. It's a massive beast standing right there, and we can all see it charging. Developers are working on quantum-resistant soft forks. There are proposals for Lamport signatures and other post-quantum cryptography. The market pricing this in is actually healthy. That's why we are seeing this consolidation and bearish sentiment for 2026. The market is discounting the asset based on that risk.
That's a massive discount.
It is. But here's the bull case on that. If Bitcoin survives this 8 to 10 year window, if it upgrades, if it hardens, the value proposition is cemented forever. This is the fire it has to walk through. It survived the block size wars. It survived the China ban. It survived FTX. Now it has to survive the threat of obsolescence.
Walking through fire is great in mythology, but in finance, you get burned. You are asking capital to sit idle in a volatile asset for a decade of hardening while the technology potentially faces obsolescence. That is a massive ask, and the data supports my skepticism. The source material highlights that volatility will stay elevated specifically because of this risk. It says institutional adoption will remain hesitant. That contradicts your earlier point that we are moving to a hardened institutional phase. You can't have it both ways. Either institutions are here to stabilize the price, or they're staying on the sidelines because of quantum risk. The data says they are staying on the sidelines.
I disagree that they are mutually exclusive. We are seeing the start of institutional engagement, but it is selective. The tourist institutions are gone. The ones remaining are the ones who understand the tech and the risk-reward ratio. And regarding the lack of retail, which you mentioned earlier as a negative, I think that ties into this. Retail doesn't understand quantum risk. Retail chases green candles. The fact that price is consolidating suggests that the market is comprised of sophisticated actors who are pricing these risks in real time. This is what a mature market looks like. It's boring. It's grinding. It's not a moon mission every 4 years.
Boring is fine if you are a bond yielding 5%, but Bitcoin is supposed to be the fastest horse in the race. If it is boring and risky, that is a terrible combination. And let's look at the immediate outlook. The forecast for 2026 is bearish or consolidation. We are talking about an estimated peak range of only $84,000 to $95,000. For an asset that was supposed to break six figures easily in 2025, that is essentially a flat line.
I don't dispute the price targets. 85K to 95K feels realistic given the headwinds.
But think about what that means in real terms. If inflation is running hot and gold is soaring to $3,000 or $4,000, and Bitcoin is stuck in a consolidation range for 2 years, you are losing purchasing power. The store of value argument takes a massive hit. The source material explicitly states that Bitcoin acts as a poor short-term store of value. It only works on long time frames. But how long is the time frame? If we have to wait 10 years for the quantum threat to resolve, and in the meantime we miss the biggest inflation trade of the century, which is going to gold, that is a broken thesis.
It is only a broken thesis if your time horizon is short. And this brings me back to the concept of the broken cycle. We are so conditioned to the 4-year halving cycle, up, down, that when it breaks, we panic. But breaking the cycle is necessary. Bitcoin cannot grow to be a global reserve asset if it is tethered to a predictable 4-year volatility schedule forever. It needs to decouple. It needs to face a recession. It needs to face high interest rates. It needs to face the quantum FUD. This is the hardening process.
Hardening or calcifying? There is a difference. Hardening implies getting stronger. Calcifying implies getting stiff and brittle. My worry is that without new inflows, without that M2 liquidity reaching the network, we're seeing the latter. The network effects are stalling. On-chain engagement is down dramatically. That isn't just whales being cautious. That is a network that is losing utility. The material mentions that Bitcoin's evolution as a medium of exchange is secondary to its store of value credibility. Well, if the store of value credibility is shaky because of gold's outperformance, and the medium of exchange usage is dropping because of low engagement, what is left?
What is left is the only decentralized, neutral, censorship-resistant monetary network on the planet. That fundamental value proposition hasn't changed just because the price didn't hit 200K in 2025. In fact, I'd argue the value is higher now because we are seeing it tested. The lack of inflows is temporary. It's a cyclical response to a global liquidity crunch. You mentioned the OG selling. Well, recycled money has to run out eventually. When the macro environment turns, when the central banks inevitably pivot, Bitcoin will still be there. And it will have survived a stress test that would have destroyed any other asset.
That's a very optimistic when. I come back to the immediate reality of 2026. The source material says a bullish invalidation, meaning a return to the uptrend, requires a clear surge in real capital flows, not narratives. We need to see money moving. Right now, the money is moving into gold and treasuries. Until that changes, Bitcoin is functionally a risk asset that has lost its correlation to the very thing it was supposed to hedge against.
I think we're looking at the same data and seeing two different stories. You see a failure to launch. I see a failure of expectations. The market expected a party. Bitcoin gave them a stress test.
I think the market expected a lifeboat, and Bitcoin gave them a volatility anchor.
Let's pivot slightly to the corporate treasury aspect again, because I think this is key for 2026. You mentioned the risk of selling, but isn't there a scenario where these corporations become the new sovereign layer? If nations start accumulating, which is the next logical step after corporations,
Doesn't that invalidate the retail is missing concern?
That's the game theory hope. But hopes aren't flows. If we're being honest, the sovereign adoption has been slow. El Salvador was the pilot. But who followed? Silence. If 2025 was the year corporate adoption peaked and then stalled, and 2026 is the year they potentially unwind, we could see prices revisit lows that people think are impossible. The $84,000 peak might be the ceiling, but the floor could be much lower if MicroStrategy or others are forced to liquidate to cover debts or appease shareholders. That is the broken cycle manifesting as a downward spiral.
That is a possibility, I admit, but I'm not convinced by that line of reasoning because it assumes these treasuries are weak hands. These are ideological allocators. And even if they aren't, the market is deeper than just a few companies. I go back to the early warning concept. If Bitcoin is bottomed out before the economy, it might also be the first to rise when the liquidity eventually returns. It is leading the dance. It stepped back first, it might step forward first.
Or it might just sit out the next dance entirely while gold takes the lead. Look, I value the technology, but as an investment thesis for the next 12 to 24 months, the data is screaming caution. We have technical debt in the form of quantum risk, we have market structure debt in the form of missing retail, and we have macro headwinds. That is a trifecta of trouble.
It is a trifecta of challenges, certainly, but trouble implies it can't be overcome.
I think it implies that the safe haven narrative is currently suspended.
I can agree with suspended, but not canceled.
Let's wrap this up because I think we've carved out our positions pretty clearly. Looking at 2026, the reality is bearish. We are looking at a consolidation year with a peak range of $84,000 to $95,000. That is the baseline. For me, the takeaway is simple. Bitcoin is currently a poor short-term store of value. It is failing to capture the liquidity that is actively flowing into gold. Without a resurgence of retail or a massive shift in institutional confidence regarding the quantum threat, the cycle isn't just broken, it's over. The narrative needs a complete reset.
And here is my closing thought. I agree that blind optimism is dangerous. 2026 will be a grind. It will be a consolidation year. But I frame this broken cycle as a necessary evolution. We are transitioning from a speculative medium of exchange to a hardened store of value. You don't get that badge for free. You get it by surviving stress tests like the one we are in right now. The retail moon phase is over, thankfully. Now we find out if the asset is resilient. It is acting as a rational, volatile barometer for global liquidity. If you believe in the long term, this is just noise. If you're a tourist, it's a nightmare. And that's exactly how it should be.
Well, one thing is for sure. The data suggests the market has moved past the hype era.
Indeed. We're entering a decade of serious structural testing.
So, we leave you with the question. Is Bitcoin failing to launch, or is it simply growing up?
Thanks for listening to the debate. We'll see you next time.